Good morning. I, Tahsin Sultana, Assistant Professor, Department of Commerce, Government First Grade College, Frasertown. Today in this session, I will be discussing efficient market hypothesis, which is a subtitle of second chapter of investment management. Here we are going to see introduction, forms of efficient market hypothesis and its implications. The learning objective of this chapter aims to provide overview of security analysis. Outcome of the session, the student will be able to understand the concept of efficient market hypothesis, recognize its different forms, and discuss the implication of the efficient market hypothesis for investment analysis. The efficient market hypothesis theory is an investment theory, and this theory was developed by Eugene Fama in 1960 at the University of Chicago. To understand this theory, we should understand first what is an efficient market. An efficient market is a market in which security prices reflect all available information and adjust to any new information. The prices of a security is a clear indication of its value at the time it is traded. So, in an efficient market, the market is truly efficient. It is not possible for an investor to outperform or beat the market averages. So, in an efficient market, the prices will reflect all the available information, and with the available information, it is impossible for an investor to outperform or beat the market. And the stock prices in the efficient market are the indicators of its true value. That is the meaning of efficient market. What is efficient market hypothesis? According to Professor Eugene Fama, in an efficient market, competition among the many intelligent participants leads to a situation where at any point in time, actual prices of individual securities already reflect the effect of information based both on events that have already occurred and on events which as of now the market expects to take place in the future. In other words, in an efficient market at any point in time, the actual prices of a security will be a good estimate of its intrinsic value. This definition says that there will be intense competition in the capital market and there will be intelligent participants. Intelligent participants are nothing but the investors. The information that investors need to make investment decision is widely available. It will be thoroughly analyzed and it will be regularly used. This definition also says that the market price of your stock adjusts quickly and on average without bias to new information. So there is no reason to believe that the prices are too high or too low. It will be priced accurately. The security prices adjust before an investor has time to trade or make profit from a new price of information or from new piece of information. So the market is very, very quick and it will quickly adjust to the new information. It will not give any chance to the investors to beat the market or outperform the market. The intrinsic value, the meaning of intrinsic value is the true value or the real value of this stock, which should have been priced after taking into all the information which is available about the company, which is a true value, which is intrinsic value. Efficient market hypothesis has got three forms: weak form, semi-strong form, and strong form hypothesis. The graphical representation of efficient market hypothesis, you can see here is the weak form, which will cover least form of information. Then there is a semi-strong form which also have weak form. Then last one is strong form which also includes weak form and semi-strong form. In this diagram, the circle represents the amount of information that each form of efficient market hypothesis includes. Note that the weak form covers the least amount of information and the strong form covers all the information. All the information. It includes both weak form and as well as semi-strong form. Also note that each successive form includes the previous one. Semi-strong form includes weak form. Strong form includes weak form as well as semi-strong form. So what kind of information weak form have? All historical prices and returns, past information about the company, past price records of the company, past returns of the company. Semi-strong form, it has got all public information, commonly available information, which is known to market, which is common in the market, which everyone knows in the market. Strong form includes all public as well as private information. Weak form assumes that the current stock prices totally reflect all securities market information contained in the past prices and volumes. The weak form of efficient market hypothesis says that past prices, volume, and other market statistics provide no information that can be used to predict future prices. It says that the past information, the past prices, the past results of the company should not have any association with future movements. Taking that information, you cannot predict the future movement of the stock. If the stock price changes are random, so if there is any new piece of information also, the stock market will be very, very quick and fast in accommodating that information and reflecting the correct value, intrinsic value of the stock. Here, technical analysis cannot help. So here, technical analysis repudiates, refers to it is of no use, it is useless. What is technical analysis? Technical analysis is the study of past records of the company, referring the charts, studying the charts of past stock prices, which happen to find patterns they can exploit to make extra profit or beat the market or outperform the market. So the studying the past records of the company, the history of the company, the past price or returns records of the company is of no use, because the price which the market is showing now is the correct price, is the intrinsic value which has already accommodated or reflected all the past records. The semi-strong form says that prices fully reflect all publicly available information and expectations about the future. It assumes that stock price fully reflect all relevant information publicly available, which is commonly available, which is known to every investor, which is known in the market, there is nothing new about that information. So, extending the weak form of hypothesis, here prices reflect not only past information but also all the public information, as we have seen graphically. Semi-strong form include weak form also. So, it has taken into consideration the historic information from technical analysis as well as the information from fundamental analysis. So it is based on fundamental analysis. The information which is publicly available, which is known in the market, is based on fundamental analysis. So what is fundamental analysis? Studying the earning and dividend announcement, technological news, the economic news of the company, political scenario, technological advancement, dividend yield ratio, or anything about appointment of the director or resignation of the director. These are all common information which will be available in the market, which is known to every investor in the market. This information will not at all help an investor to outperform or earn the profit more than average. Investor need not bother about this information for buying decision because this also reflects in the prices. The semi-strong form, if correct, repudiates fundamental analysis. It makes the fundamental analysis useless. Next is strong form. The strong form says that prices fully reflect all information, whether publicly available or not. The strong form assumes that stock prices reflect all information available from public as well as private source. No investor will be able to gain above average. Even insider information will not help in gaining above average. Even the knowledge of material, non-public information means private information cannot be used to earn superior results or outperform the market or beat the market. So, but this is not true. Most studies have found that markets are not efficient in this sense. So there are every chance that if the private information is available or insider information is available, investors will outperform the market. Let us go through the summary. Weak efficient market hypothesis. You cannot beat the market with the historic information because this historic information is already reflected in the current price of the stock. Semi-strong efficient market hypothesis says that you cannot beat the market by using any public information which is commonly available, which is known to everyone in the market. All public information is reflected in the current price of the stock. Strong efficient market hypothesis says that you cannot beat the market by using public or private information which is available because this public and private information is also reflected in the current price of the stock. The implication of this theory. Before going to implications, the rationale behind this theory is that market anticipate future development in an unbiased manner, and hence the stock prices may already have incorporated the information. Example, if the company is on the verge of revolutionary discovery, the market would have anticipated it and adjust the prices accordingly. Now let us see the implications. The first implication is security selection become less important because securities will be fairly priced. It says that there is no reason to believe that prices are too high or too low. It says that it will be correctly priced in the efficient market. There will be a small role for professional money managers. So the market prices of a stock adjust quickly and on average without bias to the new information. So there is no need of taking any help of professionals in deciding where to invest, in which company to invest, taking investment decisions. It makes little sense to time the market. So it does not, the information, the new piece of information will be reflected very fast, will be very quick, and the prices will quickly reflects all the quick information which is available in the market. So it makes little sense to time the market. Multiple choice questions. A efficient market hypothesis states all public information which is reflected in the current market price is classified as public information is classified as semi-strong efficiency. Efficient market hypothesis says that in which all public and private information will be reflected is strong form of efficiency or strong form hypothesis. The present value of dividend which is expected to be provided in future is classified as intrinsic value of stock. The value of future dividend after the horizon date is classified as hypothesis value or horizon value, terminal value, both B and C. It is both B and C. In an efficient market, it is safest to invest in which index fund? Stock with high returns, bond, money market accounts. The answer is index fund.